Core idea. Corporate structures and legal entities are among the most complex and enduring methods employed in money laundering. Unlike cash, these methods rely on legal formalities and jurisdictional fragmentation to hide ownership, control, and the true source of funds. Why it matters. Companies, trusts, and foundations serve as legitimate instruments for commerce, but they can be dangerously misused. Criminals use them to hide activities through complex legal arrangements and nominees, fueling corruption and tax evasion. Practical application. We must focus on transparency around beneficial ownership, addressing governance weaknesses, and closing regulatory gaps. Our analysis aligns with FATF recommendations 24 and 25, adhering to the latest international transparency standards. Example scenario. Consider a network of shell companies used to hide the true owner of high-value assets across multiple jurisdictions. Core idea. Complex corporate groups with numerous subsidiaries and holding companies are often used to hide ownership and control. While common in multinational firms, these structures can be exploited for money laundering when transparency is lacking. Why it matters. Layered holding companies can transfer funds internally via intercompany loans or fees, presenting them as legitimate activities. These internal movements can effectively conceal illegal transfers by disguising them as routine corporate financial activities. Practical application. AML standards require institutions to comprehensively understand group structures and the flow of funds between entities. Complex structures that lack a clear business rationale are considered significant risk factors in compliance assessments. Example scenario. Consider a group using management fees between subsidiaries to move illicit profits into legitimate parent company accounts. Core idea. Complex ownership chains comprise multiple levels of corporate ownership, often spanning multiple jurisdictions. This opacity at each level complicates the identification of the ultimate beneficial owner, or UBO. Why it matters. Layered ownership structures are intentionally created to hinder due diligence, forming a cascade that obscures control. Companies might be owned by other companies, trusts, or foundations, making it difficult to identify who is truly accountable. Practical application. We must look beyond formal ownership to identify the natural persons who ultimately own or control entities. The FATF notes that complexity can serve as a risk indicator, especially when not supported by a clear commercial rationale. Example scenario. Consider a local company owned by a holding firm in a tax haven, which is itself controlled by a private family trust. Core idea. Corporate service providers, or CSPs, play a valid role in management, but their services can reduce transparency through mass entity formation. Criminals exploit CSPs to rapidly establish numerous entities with nominee directors, shared addresses, and standardized governance. Why it matters. As CSPs expand globally, oversight can become fragmented, creating significant risks for misuse in money laundering schemes. The global reach of these providers often outpaces regulatory coordination, making it easier for illicit actors to hide their activities. Practical application. Institutions must evaluate concentration risks, such as when multiple unrelated entities are linked to a single provider. Frequent reliance on the same CSP across diverse clients is a known risk indicator that requires enhanced scrutiny. Example scenario. Consider dozens of shell companies from different countries all using the same registered office address and formation agent. Core idea. Corporate migration involves relocating a company's legal headquarters from one jurisdiction to another without dissolving the entity. While it can be legitimate, this process can be misused to reset disclosure requirements and exploit regulatory loopholes. Why it matters. Criminals move entities to jurisdictions with less strict beneficial ownership rules, making it significantly harder to trace history. Each migration adds new registries, advisors, and compliance points, effectively disrupting investigative continuity for regulators. Practical application. Institutions should reevaluate risks during jurisdictional changes, re-verifying beneficial ownership and examining operational continuity. From an AML standpoint, Redomiciliation without a sound business rationale is a significant warning sign that requires immediate action. Example scenario: consider a company that suddenly moves its headquarters to a known secrecy jurisdiction just as an international investigation into its activities begins. Core idea: corporate service providers, or CSPs, play a valid role in management, but their services can reduce transparency through mass entity formation. Criminals exploit CSPs to rapidly establish numerous entities with nominee directors, shared addresses, and standardized governance. Why it matters? As CSPs expand globally, oversight can become fragmented, creating significant risks for misuse in money laundering schemes. The global reach of these providers often outpaces regulatory coordination, making it easier for illicit actors to hide their activities. Practical application: institutions must evaluate concentration risks, such as when multiple unrelated entities are linked to a single provider. Frequent reliance on the same CSP across diverse clients is a known risk indicator that requires enhanced scrutiny. Example scenario: consider dozens of shell companies from different countries all using the same registered office address and formation agent. Core idea: foundations and hybrid structures, which combine elements of corporations and trusts, are used for asset management and philanthropy. Their flexible governance and minimal disclosure requirements can be used to distinguish between control and ownership, posing significant risks. Why it matters? In laundering, foundations can own assets or act as shareholders, all while obscuring the involvement of founders or beneficiaries. Cross-border foundations further complicate transparency, creating a web that is difficult for regulators to untangle. Practical application: regulators require enhanced due diligence, including the identification of founders, protectors, controllers, and beneficiaries. Unclear governance rights or economic beneficiaries raise significant AML risks that must be addressed through rigorous verification. Example scenario: consider a foundation used to hold high-value assets where the true controller remains hidden behind a series of protectors and nominees. Core idea: insolvency and liquidation procedures can be exploited to launder or dissipate assets under the guise of legal proceedings. Criminals may transfer funds to entities that are subsequently liquidated, making it difficult to trace funds and enabling asset shifting. Why it matters? These procedures disrupt audit trails, effectively hiding the historical path of illicit transactions. Dormant entities can also be reactivated after insolvency to access funds, often with less oversight due to prior inactivity. Practical application: AML guidelines mandate that institutions vigilantly observe corporate life cycle changes and reactivated entities. Unexplained insolvencies and rapid liquidations following fund receipts are critical red flags that require immediate escalation. Example scenario: consider a company that receives a large illicit transfer and immediately enters liquidation, settling debts with related parties to shift the assets. Core idea: frequent corporate restructuring like mergers, acquisitions, or dissolutions can disrupt audit trails and complicate AML analysis. Criminals may intentionally reorganize entities to evade scrutiny, using the resulting complexity to hide their tracks. Why it matters? Each restructuring results in new documentation, which can effectively obscure historical ownership and transaction patterns. This typology is particularly helpful for criminals when changes occur across various jurisdictions or involve entirely new entities. Practical application: regulators mandate that institutions monitor corporate life cycle events and reassess risk whenever significant changes occur. Repeated or rapid restructuring without a clear business rationale is a significant warning sign in any AML assessment. Example scenario: consider a company that suddenly shifts its focus and structure through 3 rapid acquisitions, each in a different jurisdiction. Core idea: nominee directors and shareholders are individuals listed in official records as officers or owners, but they do not exercise actual control. Their primary purpose is to obscure the true beneficial owner's identity from regulators and financial institutions. Why it matters? These arrangements often involve professional service providers, creating a layer of legitimacy that can hide illicit activity. While nominee services can be legal, their improper use to facilitate money laundering poses a substantial global risk. Practical application. Financial institutions must verify if declared directors possess genuine decision-making authority and economic interests. Employing nominees without clear disclosure is a significant red flag under international AML standards. Example scenario: a nominee director is appointed for a company that launders millions, yet they have no knowledge of the firm's business operations. Core idea: offshore companies registered in low-tax or secrecy jurisdictions are often used in money laundering due to favorable regulatory environments. These jurisdictions offer minimal disclosure requirements and robust confidentiality protections, making them ideal for obscuring illicit funds. Why it matters: these entities can hold assets, process payments, or enable cross-border transfers as part of complex money laundering schemes. Offshore structures are frequently combined with correspondent banking and trade-based money laundering to develop intricate global networks. Practical application. While offshore incorporation is not illegal, financial institutions must conduct enhanced due diligence and assess country risk. Regulators identify certain jurisdictions as higher risk, requiring rigorous verification of ownership and control transparency. Example scenario: consider an offshore company used to hold the deed to luxury real estate, purchased with funds layered through multiple secrecy jurisdictions. Core idea: partnerships and limited liability entities like LPs and LLCs offer flexibility in ownership, profit sharing, and governance. These characteristics can be misused to conceal beneficial ownership and enable money laundering. Why it matters: in some jurisdictions, partnerships are not subject to the same disclosure rules as corporations, enabling criminals to hide behind silent partners. Profit shares can be deliberately modified to shift value secretly, complicating the trail for investigators. Practical application. Institutions must identify controlling persons, not just registered partners, to meet international standards. FTF guidance indicates that beneficial ownership covers all legal persons and arrangements, regardless of their specific structure. Example scenario: consider an LLC where a silent partner provides illicit capital while a legitimate managing partner handles all visible operations. Core idea: shell companies are legal entities that have no actual business operations, employees, or physical offices. They primarily serve as legal shells to facilitate the transfer, holding, or investment of illicit funds in money laundering. Why it matters: criminals often use shell companies to open bank accounts and conduct transactions that appear legitimate on paper. Registered in jurisdictions with minimal disclosure, these entities keep true owners hidden behind nominee directors or shareholders. Practical application. From an AML perspective, shell companies pose a significant risk due to their lack of economic substance. Financial institutions must verify genuine operations and valid business reasons, as shell entities drive many global enforcement actions. Example scenario: consider a network of non-operational companies in different tax havens used to layer funds through a series of fake service contracts. Core idea: special purpose vehicles, or SPVs, are entities established for specific objectives like asset isolation, but they can be exploited to obscure funds. While SPVs perform legitimate financial roles, their structure allows criminals to shift risk and hide the true flow of funds. Why it matters: criminals may establish SPVs to conduct isolated transactions, making activities appear legitimate while hiding the broader laundering operation. Because SPVs are often viewed in isolation, it becomes difficult for regulators to see the full picture of illicit financial movements. Practical application. AML frameworks require analyzing the economic purpose and funding sources between SPVs and their parent entities. Opaque ownership and weak governance in these structures pose significant risks that institutions must rigorously monitor. Example scenario: Consider an SPV created for a specific infrastructure project that actually serves as a conduit for layered funds from unrelated illicit sources. Core idea: trusts and private foundations are legal structures created to manage assets for beneficiaries, separating legal ownership from control. Their ability to shield assets makes them appealing for protection, but also poses significant risks of misuse for money laundering. Why it matters? In laundering schemes, trusts can serve as intermediaries, often hiding the identities of settlers, trustees, and beneficiaries. Cross-border trusts add additional complexity to oversight, making it harder for regulators to track the true source of funds. Practical application. FTF Recommendation 25 emphasizes transparency, requiring institutions to ensure access to precise beneficial ownership data. Financial institutions must rigorously understand the structure, purpose, and all parties involved in any trust arrangement. Example scenario: consider a trust used to funnel illicit business income to beneficiaries through a series of anonymous shell company distributions.
Thank you for watching this lesson. If you found it helpful, please like the video and subscribe for more AML and compliance training. If you would like to earn an anti-money laundering certificate, please visit www.naecacademy.ca. The first course is free and eligible for certification. I'll see you in the next lesson.